everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi, and this is the show where we get you your daily dose of personal finance news, views and opinions. So here's what we are going to discuss today on the show. Emergency funds. We often stress on the importance of maintaining one, and luckily for a lot of Indians, we do have this habit that's sort of inculcated right from when we are young about the importance of saving money, keeping it away for a rainy day. So that essentially will just take on board a more professional term in the form of emergency funds. But it's not enough to just take that money and stuff it at home. You need to ensure that emergency fund as well is put into the market and for safekeeping. And also, what should you do if, let's say, you are in the need of urgent cash, which I'm sure because of the coronavirus and the crisis that it has created, a lot of you may have unfortunately found yourselves without a job and staved off cash. In such a situation, of course, an emergency fund does help. But remember that the lockdown has been in place all the way since March. We are 6 months into the lockdown. I'm sure many of you, now that we've finished 6 months officially, may have run out of your emergency fund as well. So what should you do next? That's essentially what we plan to discuss, and for that I have with me Amit Kukreja. He joins us on the show, and remember, he'll be also answering your questions and queries, so write into us on the money show at etnow.tv. Later on the show we'll be discussing all about ETFs, finally, in our Spend with TMS segment, we will be talking to retailers, or more specifically, the head of the Retailers Association of India, on what exactly are the preparations looking like for the upcoming festive season. What can customers expect, given the fact that, things have been pretty tough in the last couple of months? So what kind of service as well can customers expect? Will retail outlets go above and beyond to cater to the customer? Okay, well, first things first, let's kickstart the show then and introduce our very first guest, none other than Mr. Amit Kukreja. He's the founder of Amit Kukreja Advisory. Thank you so much for joining us today. All right, well, before we do that, let's go across to my colleague Priyanka, and this is with respect to news around the restructuring norms for SBI borrowers. If you've taken a loan from SBI, the bank has essentially given some guidelines on how exactly you can go about with restructuring your loan in case of you finding yourself unable to repay the loan. Priyanka, take it away.
Well, yes, State Bank of India has laid down norms and provisions for one-time restructuring of corporate loans. Now, what State Bank of India has said that there will be an option of an additional moratorium of up to 2 years on term loans. Also, there can be an extension in the tenure of the loan by up to 2 years' time. And the interest moratorium can also be granted for up to 6 months for companies that are seeking one-time corporate restructuring. Now, talking about working capital, SBI has said that need-based additional funding will be provided by the bank, but this has to be repaid within 5 years from the time the loans are issued. They have also sought promoters' contribution of around 10 to 15% if additional loan facilities are sanctioned. And in case of unlisted entities, promoters will have to furnish personal guarantees. In case of listed entities, promoters will have to pledge shares. So this will ensure that companies which have genuinely been affected by COVID-19 are only given the restructuring. The other eligibility requirements will be as set by the RBI framework and the KV Kamath Committee recommendations. So those will definitely have to be followed. Strict timelines will also be followed according to what RBI has laid down. But these loans that SBI will give will be sanctioned, will be priced 100 basis points above the interest that the current loans of those companies are. The last date for applications for loans worth 1,500 crore rupees and above is November 15th, while for other loans it's November 30th. So this is what the SBI has laid down for the one-time corporate loan restructuring.
All right, Priyanka, thank you so much for that. Well, we'll definitely on the Money Show as well try to bring SBI themselves to really talk about this entire procedure of getting your loan restructured in case if you find yourself unable to service your next EMI as and when it falls due. Okay, well, let's kickstart our show then. And like I told you, we'll be talking about the importance of maintaining an emergency fund. How can you build one up? And for that, we have with us Amit Kukreja. He's the founder of Amit Kukreja Advisory. Thanks so much for joining us today on The Money Show. Hope you're doing well. Amit, like I was saying at the beginning of the show, we are now in September. It's literally the 22nd of September. Exactly 6 months ago, on the 22nd of March, our Prime Minister had ordered this Bharat Bandh, the nationwide lockdown, for just that one day. But who knew, right, that it's going to then become a more long-term thing. So yeah, it's been 6 months. Ordinarily, when we say that, okay, you need to create an emergency fund, we say that it should be 6x of your expenses. For a lot of individuals, unfortunately, they may have run out of these emergency funds by now, right? How would you recommend they essentially manage, their finances, their cash flows in these difficult times?
Yeah, I mean, this is one of the very unusual times, and a lot of people have exhausted the 6-month emergency fund already, and they don't have the clarity on what the job situation is going to be like 3 months down the line or 6 months down the line. So it is one of the most difficult times that some of the people are facing. And I guess the time has come when they should have started liquidating their other financial assets, which they had earmarked for short-term or long-term goals. They will have to bite the bullet, take out money from the savings or from the investments that they had labeled for short-term goals, which is next 3 to 5 years, or long-term goals, which is beyond 5 years and up to 10 years. It's time they need to liquidate that and figure out a strategy how the liquidation can be done with maximum tax efficiency and from the assets which has maximum liquidity. And if they have made profits, then it's probably time to book the profits as well.
So the easiest things, to liquidate, like you as well mentioned, right? You should look ideally in order of liquidity are, let's say if you have any individual equity shares, then that, mutual funds in debt or equity, then you have bank FD, so on and so forth. And all of these were essentially meant to cater to a goal, or at least that's what, you speak about when you say financial planning. You want, for example, your long-term goals, like retirement can be catered to by investing in equity MFs. Similarly, if something is due for, being revealed in the next 3-4 years, like for example, maybe buying a car or something, that would perhaps be in debt MFs. So how should you essentially stack up? And I'm not even getting to things like gold and homes, which either have sentimental value and when it comes down to selling a home, it's a very, very serious matter. If you actually think that you should liquidate your home and perhaps move into rent, that's a very serious matter altogether. So let's talk about then this bit on which assets to liquidate first from the more liquid ones.
Sure. So as I was saying in the previous answer, that this is a very unusual time. It's a time when you should take a stock of what your financial life is going to look like 3 months down the line, or what does it look like now, which means you take a step back, revisit all your financial goals, given the liquidity that you require at the given moment. And you also revisit all your important aspirations. You revisit your expenses, you revisit your incomes, if there are incomes ongoing, or if the incomes have stopped. Then you revisit, how do I create a withdrawal strategy from what I have accumulated in my career so far? So look at liquidating your equity mutual funds first. If you had a goal, the fulfillment of that goal is 3 years away from it. Maybe it's time you book your profits and exit equity mutual funds, because equity must have given you a good returns. We had a deep correction back in March. The markets have had a big run up in last 6 months, and it's time to book your profits. So book your profits in equity mutual funds if your goal is within the next 3 to 4 years. You can book your profits and exit from debt funds. You can break your fixed deposits. These are all liquid assets. You have to carefully look at the exit clauses or the tax liability of each exit. So if you're booking profits in equity and if you have had a holding period of more than 365 days, then obviously tax is the least. 10%. But if you have debt funds and you're liquidating within 3 years holding period, then you have a tax liability of your income tax slab, which could be 30%, 20%, or 10%. FD is your income tax slab. So you have to carefully look at what is the tax I'm paying on each liquidation of the asset and do the assessment which is costing me least money in terms of taxes and which is bringing me maximum profits post-tax. That's the money I would go and liquidate first.
Yeah, well, I guess that is something that's logical as well. That which is the one that's generating the most returns, which is getting you the most cash post-tax. You need to ensure that you take into consideration the taxation implications as well before you consider liquidating assets. Real estate and gold. Amit, what would be the considerations you'd place around these two assets before viewers start thinking that okay, maybe it's time to liquidate some gold? Or if you have realty, again, not the self-use one, but maybe if you have something spare, maybe something that's ancestral, that should be liquidated.
Yeah, I mean, if you have a house already, which is a self-use house, and you have another real estate, which is purely investment, you can think of liquidating that real estate. I don't think you're going to have another bull cycle in real estate, at least for next 3-4 years. These are crisis times of the century, and real estate does not bounce back so easily in such difficult times. That's number one. Number two, you can also consider selling real estate because the rental yields in real estates are no more than 2.5%, maximum 3%, that too in a small town. But if you're living in a metro, your rental yields could be hovering around 1% to 1.75% or 2% max. So real estate without the capital appreciation and with a yield of around 1 to 2%, which is not even inflation, might be a good call to exit and book your profits and take out the money. Second one is gold. Of course, we all have attachment to gold, particularly ladies. If there is not much of an attachment to gold, then you can liquidate gold also. We have had a big rally in gold because of the global uncertainty around the trading, international relations, and all that. So this is a good time to book your profits in gold as well. These two asset classes are very tangible asset classes. You really have a good sense of wealth when you see this because you can feel it, you can go visit it, you can use it, you can show it off. But the other assets are financial assets which are mostly intangible in nature. So it's very likely that you get attached to these tangible assets. But it's time you let go these tangible assets and financially strengthen your portfolio and your financial life by booking your profits and make sure that these assets are now working for you as opposed to keeping the money, hoarded in their tangible form. And now that the times are good, the rally's there in the gold market and real estate is going to be very flattish. It's time to get out of real estate or get out of gold because I think things will normalize in the next 3 to 4 months, and gold prices will probably start tapering down.
Yeah, makes sense. I mean, we've seen a very, very rapid rally come by in gold prices, this year. But again, in the last 1 odd month, things have been relatively cooler, stable, not much momentum from that 51,000 odd rupee level. So, yeah, maybe people could consider if, of course, there are no sentimental values attached, and if you are finding yourself in a bit of a cash crunch, it would make sense to, sort of liquidate some of your gold. And most definitely, we're sitting on a profit when it comes to gold. Realty as well, like Amit rightly mentioned, I think for the last couple of years, there's been very limited appreciation or almost no appreciation in especially residential real estate prices. I think Amit, the bulk of it already went by, in the 2000s perhaps. But yeah, of late, even the yields, in fact, from residential realty is pretty low. So in a worst case scenario, if push comes to shove, you could consider that. Amit, what's your opinion on taking a loan and withdrawing from your provident fund? I know both are completely not related to each other, but yeah, often we say that these are both worst case scenarios because even when it comes to withdrawing from your PF, you're basically withdrawing from your retirement kitty, and loan again, you're borrowing from your future in a way.
So I would take the easy one first. Avoid withdrawing money from your provident fund account as much as possible. It's the best form of returns at the moment. Tax efficient, 8.5% guaranteed, with compounding, has a phenomenal growth, has a phenomenal accumulation power. So if you can avoid withdrawing money from your employee provident fund, you must. Second, loan. I am not a supporter of taking money or borrowing monies during the difficult times, because these are the times when we should be prepaying all the loans that we have, because we have learned that there could be uncertainty in our life anytime, any moment, and we are better off without the borrowings. But if there are not enough savings, but if there are not enough investments, there's no money in the cash account, what do? We have no choice but either to withdraw money from the Provident Fund account or to borrow. I would suggest explore borrowing money from your friends and family that you can repay back. If you have a potential of, if it's a matter of deferred salary, then you can borrow the money from your friends and family. And once your salary arrears are back in your account, you can pay it back. But if it's a matter of no salary at all, then you might be better off borrowing money, in the private loan or personal loan or any other borrowing capacity. Use that capacity and see what best you can do in terms of starting to pay off the EMI. But keep the loan as the last option. EPF, again, take the money out only if it's a very temporary requirement. But if you think it's going to be a long-term requirement, then work with an expert and see what is making sense. Loan at a particular rate of interest vis-a-vis pulling the money out from your EPF account, and see what the pros and cons are of each approach, and then accordingly take the call.
Okay, all right, there you have it. Those are some important recommendations to follow from Amit for those individuals who are finding themselves in a really tricky spot. Amit, for the ones that are a little more fortunate, in the sense that mercifully they have not lost their jobs, or their businesses are not disrupted. I'm sure they are as well realizing the importance of having an emergency fund. So let's say if they've learned their lesson from this pandemic, how do you recommend they start off? Where should they park this emergency fund once they've accumulated the corpus?
If you have a good salary, if there is no impact on your incomes, and if your tax bracket is 30%, I would always recommend a debt fund to keep your emergency fund, because what it does, it gives you tax efficiency. You get the advantage of indexation and a lower tax slab. But if you're already in a 10% tax bracket or 20% tax bracket, you might be okay to put fixed deposit. But I've seen that in debt funds, you always make, most of the times you have made the rate that you make in fixed deposit, you make it 1% more than that. So you're still better off keeping the money in debt fund. Just have a good debt fund selected for your emergency fund. You could park the money in liquid, you could park the money in ultra short, low duration, or even short-term fund for that matter. Ensure the debt fund has maximum, at least 85% of its underlying assets are AAA rated or A1 plus rated papers. And you get, if you don't get to withdraw money in next 3 years, then you end up having indexation, which means better tax efficiency, less taxes to the tax department. So I am always a proponent of keeping the money in debt funds for your emergency fund.
So whatever you accumulate in emergency funds, ensure that you park it, or at least Amit recommends that you could consider parking it in a debt fund. You should be able to have easy access to it, and there should be very little volatility, for your emergency fund. Okay, well, let's take on board some questions and queries we've received from our viewers. Remember, folks, if you would like to talk to Amit Kukreja, want to create a financial plan for yourselves, you can write into us on the Money Show at etnow.tv. So let's take on board our queries that we've received for now. We have Kanan PK, who's asking me a very straightforward question, Amit. He says, I've invested in the Bharat 22 ETF in the IPO stage. I'm awaiting a positive return since long. What's your outlook, Amit, on the future of this fund? Bharat 22 ETF, as the name suggests, it's an ETF, invests in the in the Ratnas of India Inc., as they call them. the big PSUs. It was used as a vehicle for the government as well to divest its stake in some of these shares. What's your view on the Bharat 22 ETF, Amit?
Well, if the entire Bharat is going through a pandemic crisis, then there's no way you're going to make money from it. So let's give it some time. We cannot time the market. We know that very well. So let's give it another couple of years and see how times change and how the recovery happens from this crisis attributed to the pandemic. And based on the progress that we make, based on the GDP growth and other change in numbers, which matter to us a lot at the economic level, we should have a turnaround in the ETF valuation. Let's give it a couple of years, I would say.
Okay, well, rightly said. At this point of time, everyone will have to be, switch on their patience mode, their wait and watch mode, because, we are in tough times, obviously, because of the pandemic. So just be a little more patient. That will prove to be a virtue here. Okay, Madhukar Sharma writes that in March, I had moved 90% of my portfolio to liquid funds. Is this the right time to switch back to equity funds? I'm assuming Madhukar has just simply stopped any SIP, or he's completely not invested at all in equities, and whatever corpus he had accumulated in equity funds, he moved it to liquid funds. Now he wants to know, is now the right time to switch to equity funds? Firstly, Amit, is this a good strategy to deploy, especially for those individuals who are doing SIPs? That on the brink of any crisis, you suddenly sell off or redeem your equity funds and move that money to liquid funds, and even the costs as well, right, that are involved with doing something like this. What's your opinion?
I have never recommended anybody to stop the SIPs, and particularly when we had a fall back in March and April and corrective cycle going through March, April, May. We know it very well by now that the run-up that we have had since then has actually given huge returns to people who continued their SIP. So I'm not sure if the gentleman had pulled the money into liquid and if he did restart his SIP. If not, then he missed out a big run-up. And this should be a big lesson for him. Never try to time the market. Never. Unless your money is needed in next 2 to 3 years, then this call must have paid him off. But if the money is not required in next 6 to 7 years, you should not pull out the money from equity, rather continue to buy through SIP or do through STP. Some tactical calls might have been advisable, but that is only in the case when your goal is within next 2 to 3 years. So the decision to withdraw or continue or buy more should be purely based on the goals that you have in your financial plan, whether they are short-term, immediate term, or long-term goals. Only according to the horizon that you have for the goals, you can take such tactical calls. Otherwise, normally they backfire. So if the person has missed the bull cycle that we have had in last 3 to 5 months, then unfortunately, he shouldn't start now, because the PE ratio is very high, more than 32%, more than 32, maybe more than 35. I don't know what the latest number is. But again, do the STP or the SIP rather than buying lump sum, and continue to buy that, provided the goal is 5 to 6 years away from today. So it should be a goal-based decision is what I'm trying to say.
Yeah, absolutely. It should be a goal-based decision. Maybe even if there's a crisis coming, maybe some tactical changes, but not something so dramatic. And yeah, I guess, Amit, in my opinion, when the markets are down and you pause an SIP, you're actually giving up on the chance of accumulating units at a lower price, more units at a lower price. And that's the whole point of doing an SIP, right? That you pick up a few units of mutual funds in every price point, whether the market is up or down. So I guess maybe that's also a drawback, of sort of pausing your SIPs. Amit himself also, of course, does not advocate at all that you should pause your SIPs, unless, of course, your goal is nearby. Okay, let's take on board our third query. Narayanan Iyer says, I have 2000 SIP going on with Mirae and HDFC. Okay, he hasn't mentioned which are the funds that he's purchased, but he says he's got this 2000 rupee SIP going on for the last 3 years. He has another 3 lakh rupees to invest. But now his question is, should he buy more in mutual funds or should he buy stocks now with this 3 lakh rupees? We don't know how much experience really Narayanan has in stocks as such, except for this 2,000 rupees that he invests in two SIPs, which I'm assuming has any which way has been going on the side for the last 3 years. What would you recommend to viewers like Narayanan? Unfortunately, he hasn't mentioned his age or his goals. But yeah, I'm sure a lot of people, Amit, may have come to you as well asking for direct share trading, because we've been seeing this trend as well, right? About more and more retail investors sort of trying to now enter the share market and indulge in some trading.
I would suggest that do shares only if you can evaluate the stock technically and fundamentally, both ways. So if you can evaluate the charts, if you can do the fundamental analysis of the stock price, how the company is doing, then you can invest in stocks. My concern is if you enjoy doing the assessment and analysis of stocks, do it. Otherwise, there is too much turbulence in the market. There's too much turbulence in the company performance also these days. The longevity of or the consistency of a company performance has kind of reduced significantly if you look at the companies that it used to be 20, 30 years ago. If you can stay away from stock analysis and you still want exposure to equity investments, mutual funds are the best options. You can choose different classes of mutual funds: mid cap, multi cap, large cap, balanced, value, large and mid cap. But when it comes to stocks, it has to be a very careful decision based on your own homework about the stocks. So if you enjoy doing that homework, keep your money in stocks. If not, stick with mutual funds. And since we don't know the schemes in which he has invested, the Mira Asset and the HDFC, we can't comment. I can't comment on whether to continue investing there or change the schemes. But broadly, to answer this question, I would say stick with mutual funds if you don't enjoy stocks analysis. Otherwise, you can do stocks if you are really thorough with technical and fundamental analysis of the stocks.
Okay, fair enough. That's the recommendation coming in from Narayanan. And I think we have time for one last query of the day. Aman writes into us saying that his goal is for retirement, which is 10 to 15 years away. He's got roughly about 6 funds going on. Experts told me always to add category-wise schemes. Now he wants to know if he should add a mid-cap scheme or not. He already has 6 funds, like I mentioned. He has Axis Multi-Cap, SBI Focused, Mirae Focused, DSP Equity, Tata Large and Mid-Cap, and Invesco Small Cap. So I understand why he believes that he needs, a mid-cap fund. Further, he is also asking you to suggest schemes for emergency funds and also for short term, that's for 1 year as well. And he also has another 10 lakh rupees that he can invest via lump sum. So lots going on over there. But yeah, he's created a good corpus for himself, 10 to 15,000 odd rupees of SIP each in each of the 6 funds. And now I guess further, when we look at an Axis multi-cap, the view may change a little, right? Because this Axis multi-cap as well will be having 60 to 70% in large caps. But now there will be another 25% added of mid and small caps. Would that change your opinion in any way? Do you think he needs to add a mid-cap fund?
Yeah, I would suggest to add a mid-cap fund, and I'm trying to open the names that I had recommended. For emergency fund, let's answer that first. He can park his money into Kotak Bond short term, HDFC Ultra short term, ICICI Pru Liquid Fund. He can park his money in the combination of these 3 schemes. I would still recommend use direct plan growth option if you can. Avoid regular. But if you don't have a choice, you can go with the regular. In terms of equity SIPs, I would recommend to him the 5 schemes. 1, Mirae Asset Emerging Blue Chip, which is a large and mid cap category. Axis Blue Chip, which is a large cap category. DSP Mid Cap, which is a mid cap category. And I am also sensing some kind of upward movement in the mid cap category, given the change that has been announced by SEBI. We don't know how the AMCs are going to push back to that or seek clarifications on that one. But don't be in a rush to do that change in terms of gathering mid-cap schemes or units of mid-cap schemes in your portfolio. Third, Axis Focused 25, again, a multi-cap fund. And the last one is Parag Parekh Long-Term Equity, again, a multi-cap fund, which has exposure to international equity as well. these are 5 good schemes that have delivered consistent performance. And since his horizon is for 10 years towards his retirement portfolio, I think if he can continue to invest in these direct plans for a longer term horizon and keep reviewing his portfolio every year or every 2 years for the performance, I don't see a reason why he would not be making at least 20% CAGR on these investments. They are good schemes and they have delivered consistently in the last 5 years.
Great. All right. So those are some chops and changes being recommended, Aman, for you, which Mr. Amit Kukreja has picked out to help you achieve your financial goal. And I think that's all the time we have to take on board your viewer queries. Amit, really appreciate you joining us today on ET Now. And, so simply explaining the whole process of, managing money in these tough times when, many people have unfortunately depleted their emergency funds since the lockdown as well has been in place, and the pandemic, the economic slowdown has been in place for the last couple of months. We perhaps may take a little more time to come out of this situation. And don't forget, ladies and gentlemen, if you'd like to talk to us, you can always do so by emailing us on themoneyshow@etnow.tv. For now, we'll take a very quick break, but when we return, Sanjeev Bajaj will be joining us to talk about a very interesting product being launched for customers by Bajaj Finserv. Don't go anywhere.